Hey everyone. So we will just take a minute or two to let more participants join in and then we can start the session. Hello everyone. So I think we can start the session now. I am Shruti and I take care of incubation here at Jinso. I will be host for today's session. I think I can already see so many of you logged in and honestly makes me so happy. Thank you for taking the time today and joining this session. Really appreciate it. So before we jump into today's topic, let me give you a quick snapshot of what GinServe is all about. GinServe is promoted by JSS Mahavidyapitha Mysore. So GinServe is a TPI and also accelerator dedicated to create a dynamic ecosystem for startups and entrepreneurs. Backed by Department of Science and Technology, Government of India, and Startup India Seed Fund Scheme, as well as Startup Karnataka and KDM. We have been around since 2010, and over these 15 years, we have supported around 500 plus startups and helped founders raise over 7 crore through seed funding programs. Along the way, with 80 plus mentors in our network, startups from our ecosystem have gone on to create more than 10,000 plus jobs. So, yeah, we are pretty passionate about helping founders grow. Apart from the incubation and acceleration program, we have also co-working space in our campus here at Indiranagar. So we have from two-seater desks to four-seater cabins with all the amenities available. So if you are looking for a space like this, just drop by our space and you're always welcome to come check it out, have a chat with us and see how it can work for your team. Now, I think instead of me going on and on, we actually have a short video that will give you a nice glimpse of who we are and what we do. So I will just play that quickly and you can get an idea about the gin serve. Just allow me 1 minute.
To life by JSS Mahavidyapitha, Mysuru, with the support of the Department of Science and Technology, Government of India. GinServe was born with a mission to transform innovative ideas into successful ventures and build a thriving ecosystem for tech entrepreneurs. From its humble beginnings, GenServe has evolved into a powerhouse of tech startup incubation and acceleration. Over the last decade, more than 300 startups have graduated from our programs, creating solutions that are making an impact. Our work doesn't just stop at nurturing ideas. We provide the critical resources, mentorship, and funding that startups need to grow. GenServe manages a seed fund of rupees 7 crore, investing in over 26 tech startups, fueling their growth into sustainable businesses. With over 75 entrepreneur mentors, domain experts, and coaches, we ensure that every startup receives guidance tailored to their unique challenges. The results are visible. Startups nurtured by GenServe has gone on to create over 10,000 jobs, contributing to India's growing startup economy. But it's more than just the numbers. Our programs are designed to address the specific needs of every cohort. Whether it's helping startups refine their ideas, preparing them for investment, or scaling them to new heights, GenServe is there every step of the way. Our commitment to excellence hasn't gone unnoticed. Recognized for its work, GenServe has earned prestigious awards and accolades. The Department of Science and Technology, Startup India, Startup Karnataka, and Karnataka Digital Economy Mission have entrusted us with the responsibility of supporting emerging accelerators across the Beyond Bengaluru region. At the heart of it all is our 55,000 square feet plug and play facility located in Bengaluru's Central Business District. It's a space where ideas thrive and entrepreneurs can focus on scaling their businesses. As GenServe continues to evolve, our mission remains the same: to build the future by nurturing innovation, empowering entrepreneurs, and driving meaningful change. Join us on this journey of innovation. Let's build the future together.
All right, hope that gave you a quick feel of Jinsa. Uh, and before we move ahead, a quick announcement for all the founders here. Applications are now open for Elevate 2025, which is the government of Karnataka's flagship startup funding program. So, if you are building something innovative, this is a great opportunity to get support and funding. There are some special categories also along with Elevate. So, it's Elevate Unnati for SC/ST founders and Elevate Minority. So, if you fall into those, don't miss out. The last date is, I think, 15th of September. So make sure you check it out soon and apply for that program if you are eligible. Now, before we get started for the session, let me quickly tell about what today is all about. And the topic is beyond the idea how compliance shapes startup success. And honestly, this is such an important discussion because building a startup is exciting, but staying compliant is what really makes it sustainable and, of course, investor ready. So we have planned the session like first we will have our expert speakers share her insights, and towards the end we will open it for question and answer round. And in fact, I would request all of you to make the session as interactive as possible. And if at any point of time you have a question, just drop it in the chat box or raise your hand, and we will make sure to bring it up either during the talk or in the question and answer. All right. So let's introduce our first speaker for today, Miss Mona Gupta. Mona is Principal Associate at Saga Legal, a commerce graduate and a qualified company secretary with over 8 years of experience across corporate law, secretarial practice, foreign exchange, labor law compliances, and even the insolvency bankruptcy code. And she is also certified in German proficiency. Over the years, Mona has worked with some of the leading CACS and law firms like SS Kothari and Mehta and Company, JK Gupta and Associates, and India Corp Law, where she has helped countless businesses and startups navigate the tricky world of compliance and regulations. So we are really happy to have her with us today to break this topic down in a very easy way. With that, let's give a big virtual round of applause and welcome Ms. Mona Gupta. Mona, over to you.
Thank you, Shruti. So, good afternoon, everyone. I hope I'm audible.
Yeah, you
Yeah.
are audible.
So, thank you so much for giving me this opportunity to present my views on legal compliances, a fundamental framework that every startup needs in order to flourish, scale, and eventually grow into a
Recording in
corporate
progress.
giant, or as we like to say in the startup world, a unicorn. At the outset, I want to walk you through the some of the basic legal compliances that many founders tend to overlook at the early stage. mistakes that can come back to haunt even the most promising venture. Now I know when we hear the word compliance, most people immediately think that it could be a lots of paperwork, lengthy procedure must be involved therein. But let's be honest, if I said like don't worry about the compliances, just focus on building and weight off on your shoulders. Exactly, that's the instinct most founders have, and it's completely understandable. Now you're building something new, you are racing against time, you are trying to find the product market fit. Compliance seems like that we can wait, right? But here's the hard truth, most startups don't fail because they lack the passion or innovation. They fail because they ignore the fundamentals, and legal compliance is one of them. Whether it's an issue with your incorporation, missed filing, funding done incorrectly, or just a poor documentation, small things can cause huge problems down the road. And in some cases, it can stop your growth altogether. So, yeah. So now we are starting with the roadmap for the today's session. Also, may I request your kind attention for the next hour? Think of me as your guide on the startup compliance journey, and just like a good journey, we'll take it step by step. First, we will define what makes you a legal startup in India as per DPIIT guidelines. It's not just about something being new, there's a proper legal framework into it. Then we will help you choosing the right business structure. Either it can be private limited company, limited liability partnership, or a registered partnership firm. Next, we will discuss how to raise capital because fundraising, like fundraising without compliance, is like a building a house without a foundation completely. Then we will go through the annual and event-based compliance obligations, like what's need to be filled, when it is required to be filled, and why it matters actually. Now, then accordingly, we'll be sharing the after this we'll be sharing the common pitfalls and mistakes that founders makes and how due diligence can catch them before investor will do, right? Finally, then after we will talk about the compliance first culture, when you are just ticking the box but actually building trust with stakeholders, regulators, and investors. It is beyond the investor, it is towards the stakeholders. And after that, we will have a Q&A session live. And by end of session, you won't be just know like what needs to be done. You will understand why getting it right on the day one set up for your not just for your survival, but for sustainable, fast-pacing growth for a long-term basis. So let's dive in. So why does compliance matter? Let's keep it real for a moment. Most of us don't start a business to deal with legal filings or government forms. We started because we are passionate about solving problem. But if your legal foundation is shaky, it affects everything. You will be exposed to fines, penalty, legal issues, sometimes even without realizing it. Investor may start pulling out funds or delaying funds when your documents can't check out. And worst of all, it wastes your time and energy fixing things later. That could have been done right at the very first place. On the flip side, when you are compliant, you build credibility among investors, banks, even co-founders feel more confident about it. You will always be fund ready, clear documentation with clear books, and you'll be reducing your stress because you're not carrying out any hidden risk. Right. So let's start with the first step. What exactly is a startup under Indian law? Because not every business qualifies as a startup. Just registering a business or launching an app doesn't automatically make you a startup. The Department for Promotion of Industry and Internal Trade has laid down very specific criteria about it. Here's a simplified version to it. To be recognized as a startup, it should be incorporated as a private limited company under Companies Act 2013, or should be registered as a partnership firm under Partnership Act 1932, or a limited liability partnership under Limited Liability Act 2008, right? And it should be undertake a scalable business model with a high potential of employment generation, or a wealth creation. Scalable business model in the sense of bringing some IP model or innovation in the process, in the product or skills like that. So it should be in existence and but should not be in existence more than 10 years from the date of incorporation and registration. And what I said, it should be worked towards innovation development, and turnover should not exceed in any time since incorporation in any financial year exceeding this 100 crores, sorry. Yeah, an entity which is formed by splitting up or reconstruction of an existing business shall not be termed as startup. If you are if a company has been restructured, like if a company has restructured, if company has this demerged one undertaking to another company, so that demerged company, the resulting company cannot get registration under this DPIIT Act. So a restructured company cannot be get registered. So now we come to this importance for startup in Indian economy. This will generate your job creation, bring innovation technology, and foreign investment. Foreign investment, they will attract foreign investors seeking high growth potential, bring in capital, their expertise into it, their professional expertise, and global exposure to the domestic startups ecosystem. The government real intent is to promote entrepreneurship, innovation, and job creation and the wealth generation at the very large extent by bringing the startup innovation. Right. So now we move to choosing the right cycle. Now let's quickly dive into thing that at business structuring in a nutshell. Just to revise the basics before we get into why this matters for the compliance. In India, under the legal framework of companies Act 2013, there are three types of entities which are primarily considered eligible for DPIIT startup recognition. So one is registered partnership firm, the other one is LLP, and the last one is private limited company. However, there are also other business structures like sole proprietorship, one person company, and a public limited company, which are not encouraged under this startup ecosystem, but it's still useful to understand for comparison and for future planning. First, we have the sole proprietorship. This is the simplest and most informal form of business owned and managed by a single individual. It's easy to set up, has minimal compliance, like totally, and offers full control by the proprietor. But here's the issue: the DPIIT does not recognize sole proprietorship for startup registration anymore. It's lack separation, which means the founder is personally liable for any debts or legal issue. Now you might wonder why I'm even mentioning sole proprietorship if it is not eligible. So currently government is not encouraging it, but when you are starting and when you're planning, like in case of sole proprietorship, on the later stage, if you want to convert self into the partnership firm, of course into the registered partnership, not a completely, like not an unregistered partnership, then at that stage it can be considered under the legal framework. So while it's not a right vehicle for a long-term startup growth, but it can be a stepping stone. So moving to the next is then we have a partnership firm. This is where two or more individuals come together to run a business which is governed by Indian Partnership Act. It can be recognized by startup, but the condition is that it should be registered with the appropriate authorities. This structure is easy to manage, but not ideal for scaling or raising external capital. It does not provide limited liability. Funding raising options are very limited to this compared to the other corporate structures. So creditors can come after your personal assets also. There's a huge risk lying there. Compliance is low, but it is not investor friendly. So coming to next, that is LLP, limited liability partnership. So every other structure do comes with its pros and cons. Just like the limited liability partnership is also governed by Ministry of Corporate Affairs, but under different set of law. Like it is not covered under Companies Act, it is covered under LLP Act. So here the compliances are very limited and requirements of partners same as of a private limited company. Like that is true in this case. But yes, definitely in terms of setup, where you are going to advisory set to have an advisory setup where where different dimensional professionals are involved therein, this would be a best set of structure for them. Like if multiple dimensional, like different type of professionals are coming together and they form this LLP, it would be best suited option for them. So this is a popular hybrid model. You get the flexibility of partnership, but with the legal protections of limited liability. It is recognized in the DPIIT startup framework and is fairly common among early stage service-based startups. So in terms of compliance, it is very, very low and very, very limited. And at the later stage, at any point of time, if anybody wish to convert into other set of structure, like a private company or public limited company, the conversion process is very, very smooth and same can be done through professional help. Then we can come to this 1% company. Although the startup sector, the 1% company, we don't recommend, of course, it is a better form of sole proprietorship, but also not as structured as private a public limited company. So just as vigilance in terms of other stakeholders are involved. And having said that, under this structure, there is a one person as a director and the one person as a member of the company, which we required, but which might not suitable option for you to for your future growth. Like considering fundraise aspect, although compliance wise requirements are very limited, also there is a cap under the but it doesn't attract the investors at the very first chance. So also there is a cap under the Companies Act which provides that there is a, if OPC exceeds the threshold, they have to mandatorily convert into private limited company. So if you are thinking about scaling up business in future, in later you have to convert into private limited company. So that is why we don't recommend this sector, this structure for everyone. Like for a starter base who will be growing as a unicorn thereafter. Then after we came to the private limited company. This is the most preferred structure for high growth startups. Why? Because it's allow for equity ownership, external funding, ESOPs, and clear separation of ownership and management. Most investors expect you to be a private limited company. In a startup sector, it is as an idea being formed and taken shape in the form of private limited entity with minimum director as well as the minimum shareholders also with minimum capital requirement. And now the compliance requirement become very, very smooth nowadays. And the compliance cost, which is about floating of the company, like 10 years before it was something around 15 to 20,000 for your statutory fees, but now it is as nominal and it becomes like so simple for incorporating a company in 5 days, in just a 5 days. And your compliance cost is also goes as minimum as less than 5,000 bucks. Like that's it. And finding the public limited company, this is generally not relevant for early startups. It's for large enterprises planning to go for public or already listed. It is also a form of legal structure where there are minimum 7 members are required and minimum 3 members will be required. But yes, in comparison to private limited company, there are a number of compliances which we have to adhere to. So this is not a favorable version in terms of going for the startup culture. Yeah, just a second. Now, there are as per the revised guidelines, there are certain entities which is not recognized as a startup, like company which is incorporated as public limited company, entities which is formed due to merger, demerger, acquisition, amalgamation, or absorption. However, merger amalgamation under section 233 of Companies Act 2013 for merging of two or more startup companies, or if the merging of a startup company with a small company will be allowed subject to the fulfillment of norms of DPIIT net notification. So when two small like one small company and one startup company who's already registered startup are merging, or two startup registered companies are merging together, although restructuring wise it's totally not approved, but they have given this exemption to the startups. If they are merging together, they can be allowed to be considered subject to the regulatory norms. Entities which is formed due to compromise arrangement, entities, additional entities which be having similar addresses with the same production line service, and at least one common director designated partner will not be recognized as a startup. So, and sole proprietorship. So these are the entities which, these are the structure which nowadays, like now DPIT doesn't recognize anymore. So now in moving to the advantages of private limited company, which public company cannot serve. Let's very quickly look at why private limited company are preferred over public limited company, especially for startup in the development stage or early growth stage. Now, of course, if you go for the long-term vision involves which involves manufacturing at scale, or you will planning for IPO in the future, then yes, you may eventually convert into public limited company, but not right away. For startups, they are still building products, validating markets, or raising early stage funds. The private limited routes offer speed, control, and simplicity in their way. So there is a lesser number of requirements for director members. There are tax exemptions. A privately limited company is eligible to claim tax exemption under 80 as a startup, which is not available to public limited company. In terms of faster decision making, since it has less number of shareholders and directors, so it has a less number of complexities involved in decision making. The compliance cost for a private limited company is very reasonable and definitely lower compared to public limited company. Yes, your uh, cost will be directly associated to authorized share capital because that influence your stamp duty and certain government fees. But overall, the regulatory supervision is balanced, not absent completely, but manageable. So if you're a startup worrying about recurring costs, don't be. With the help of professional, your annual cost can stay well depending on your annual transactions. One of the best features of private limited companies, especially from startup perspective, is how easily it could be transferred the ownership. In public company, shares are publicly traded, but you're subject to valuation, SEBI rules, pricing guidelines, and multiple layers of oversight. In a private company, there are restrictions. There are restrictions on freely transfer. They are not freely transferable as per law, but you can exit as a founder, bring in new founders or investors, or even can raise funds, all in relatively quick and privately manageable process without complex public filings or pricing restrictions. You can issue new shares through private placement. The investor doesn't need SEBI clearance for that. SEBI clearance mostly required for the listed companies. And let's be honest, in many startups journeys, founders move on to the ideas. For investors, they need flexibility. This structure supports that. Now I just quickly run through the comparison slide. So for partnership firm, minimum two partners are required. For LLP, minimum two partners is required, same as that. For private limited companies also, minimum two shareholders will be required and minimum two directors therein. For LLP and partnership, there is only two partners will be there. But for private and public limited company, there comes the separation. That is shareholder and a director. Another one is the director. For public limited company, it's minimum seven shareholders and minimum three directors in there. For legal status, partnership firm does not have a legal entity, and limited liability partnership offers that same as with private limited and public limited. It will be considered as a separate legal entity from their shareholders and directors. Considering the liability criteria, partnership has an unlimited liability. Like creditors can go beyond their creditors can go for the partners funds, partners own capital for that matter. And for LLP, it is limited to the capital contribution which all the members bringing in the company through the LLP agreement. And through private limited, it is limited to the shares which will be held by the members of the company, which are subscribed by the members of the company. Same as a public limited company. Registration requirement. So for partnership, it is optional. However, only registered firms can be allowed for startup. And for LLP, it is mandatory with MCA. For private limited company, it is mandatory with MCA also plus ROC. Same as with public limited. Compliance level, partnership has fewer level of filings. LLP have moderate, and private and public company have high level. But private does not have, as compared to that public limited, it has a it is not having that high level of compliances. It is moderate in comparison to public limited. In public limited, there will be a regular board meeting, journal meeting, statutory audits, and moreover thing like what depending upon your and your on your transaction size, in your like how your turnover, how your capital is raising there, then the automatically the public limited company compliances will rise eventually. So then after fundraising, venture capital, partnership firm, it's not suitable for VC or institutional funding. For limited liability, it is limited to an extent because it doesn't give that feature which private limited company offers for it. It does not have that regulatory, it does not have that like ongoing process which like LLP Act is still not completely reformed in the manner like how Companies Act has been reformed. So for private limited, it is highly suitable, preferred by investors and VCs. Same for public limited company, it is highly suitable for raising funds via IPO or through public markets. And for coming to the loan and credit facility access, for partnership firm, it is limited based on the partner credit totally. And for limited line partnership, it is would be a separate entity. So it will help in getting loan, but it is moderate in such a thing. But for private limited company, it's high because credibility and structure it will be favored by the bank most of the time. And for public limited company, it's very high and it will be strong. It will be building that strong credit worthiness and regulatory transparency in the manner. Statutory meetings and record keeping. For partnership firm, it is not required. For LLP, annual statement of accounts and solvency required. Only usually two forms we have to file with the MCA for that matter. And audit is required subject to the threshold. When it exceeds the threshold, then only audit required for the LLP. And for private limited company, board meetings, AGM, statutory or register maintenance, everything is applicable in the same manner. Public limited companies also. TPIT registration that we have already discussed. Suitability for startups. It is not recommended due to limitations. Suitable for small startups for limited liability. And for private limited company, it's the best option for scalable startups. For public limited company, it would be suitable only for the large matured startups who are planning for IPO, and then better for those large companies only, because eventually you are going through the IPOs only, and being a public limited company, you cannot avail this DPIT registration. Now coming to funding investment. Now we are moving into one of the most awaited parts of any startup discussion, that is funding and investment. I know this slide excites most of us, rightly so, because without funding, no matter how brilliant your idea is, it often remains just an idea. Startups, unlike traditional business, don't begin with existing capital or cash reserves. So funding becomes the lifeblood for the organization, especially in the early stages where survival, growth, and scalability all depend on how you will manage to attract the capital. So, but funding doesn't mean just it's a strategy. But so first step would be funding ready with your pitch decks. Before we get into who gives you money, let's talk about how you're ready to ask for it. Whenever you go for scouting for funding, whether from angels, whether from VCs or institutions or even family or offices, like the first thing you need to have is a solid pitch deck. Let me give you a small real talk here. Don't make your pitch deck too long. Don't overcomplicate it, but at the same time, make it that powerful that it speaks for itself. Your pitch deck must clearly answer these things like what is your product, what is your service, how it differentiates from the other with the other in the market, what is the problem you are solving in the at the large scale, who will be your customers, why will they come to you instead of someone else, what's your revenue model in future, what stage are you in, like what is your idea, what is your revenue, what are your growth aspects, and of course how much money do you need and what will you do with it. Basically application of funds whatever you are raising. One major point to remember, if your startup is not incorporated in India, even if the founders are Indian, it cannot be recognized under Startup India framework. That means no DPIT benefits. Now, moving to the source of funding. An investment, I know this is very favorite slide for all of us. We know that without funding, which is a lifeblood for the organization, the entire organization being a startup or any other organization by startup because they don't have funds or corporates at the beginning. So now let's look at the different source of funding. There are multiple sources, and each has its own pros and cons and ideal timing. So there are different sources, like first is bootstrapping, like self-funding. This is when founders invest their own saving in personal equipment. It has full control, no dilution, risk is entirely yours, limited runway. Usually, this is used for the early stages. Like you are the one who are bringing your own saving money and personal equipment for self-funding for the company. Second is through friends and family process in which founder raise money from the friends or the close relatives in exchange of the equity of the company. Third would be an angel investors, high net worth individuals who invest in the early startups. This will help in quickly decision making, mentorship. Your network access will be go like it will build your network access at a very large extent and will expect significant equity, this angel investor. Then it is venture capitals, like institutional investors who come in with you when you have the validated business model. They will bring the large capital inflow, have strategic guidance and follow up funding. They have high expectations and equity dilution definitely goes in. So, and also they have the stringent due diligence process to be made before making any large amount of fundraise. They often come in as a seed investment, like pre-series A or series A stages and beyond that way. Then it is incubator accelerator. They offer capital, mentorship, co-working space, and support. Ideal for every early stage founders, help building network and get validation. It will give equity take in exchange for services. It can be. And then the crowdfunding. By raising small amounts of money from the large number of people, typically online form, and it will be great for consumer facing products. Also, it will double your marketing. Regulatory and execution challenges are there in India. It is not suitable for all business models, as I can recommend for you. Then there are bank loan in NBFC. It's a traditional route for those who prefer debt over equity. There is no dilution of equity. It required credit history and sometimes any collateral security for that. Interest burden will be there. So startup can also access the credit guarantee scheme under the Startup India initiative. Then it is a private equity. It's an investment by professional managed investors for purchasing shares in a privately held manner. Then after a government scheme, we cannot ignore these. The Indian
Hi, Mona, just one thing.
Yeah,
Uh,
am I audible?
are you changing the slides? Because I think it's stubbed up.
Oh, sorry. Yeah,
Yeah,
I'm at this only.
thank you.
Yeah. So, government schemes, so don't ignore these. Yeah, as I said, so there are certain schemes like Aspire, like Pradhan Mantri Mudra Yojana, support for international patent protection in electronics and information technology, like that. So, getting funding is not just about money, it's about finding the right partner who believes in your vision. So, whether it's a small check from your friend, a convertible note from the angel investor, or a series A from the top tier VC, the goal is always the same: fuel your dream, responsibility, and stay compliant with it. Now we are moving to the fueling your vital capital. Now that's where we have talked about source of funding. Let's quickly walk through the actual instruments that startup can use to raise funds within their company. You see, fundraising is not just who gives you the money, it's also about how you structure the money within your cap table and being statutory compliant. There are there are typically three broad categories of funding instruments for startups. First is equity shares. This is a classic route. This is the most familiar route where investors get ownership in the company in exchange of capital, and through which they get the voting rights, they get dividend when declared, and a long-term stake in your company, future growth, and the last claim on the assets while liquidation. Meaning, it's your if your company shut down, equity shares will get paid after all the debts and all the preference rights cleared out. This is why equity is attractive for investor, but it's sometimes founders must think through carefully by diluting this equity. Now let's talk about legal and regulatory compliances. It is governed primarily by Companies Act, and if your investor is foreign, then FEMA and RBI guidelines kicks in, especially around pricing and FDI limits. Also, compliance requirement includes like equity share can be issued by uh, by going through the proper route, like right issue. This is when a company issue new shares but offer them first to the existing shareholders in proportion to their existing shareholding in the company. Then moving to the private placement. This is when company issues shares or securities to a specific group of investors, not to the public at large extent. It's like sending out an exclusive invites to the selected investors, or it can be, or the other mode, it would be a ESOP, which having a detailed process which will be explained later. If you are unlisted, valuation must be done by register valuer. And if foreign funds are involved, then FCGPR form must be filed with RBI with the help of professional. And don't forget about stamp duty on share certificates. So equity is simple in theory, but strict compliance required at every step. But remember, equity means dilution. So if you're not sure about the long-term control or valuation of your business, you may explore other opportunities, other instrument as in. So coming to the other instruments, that is convertible instrument. Now come as it will become as an alternative. It can be issued as a compulsory convertible preference shares. It can be a compulsory convertible debentures. It can be a convertible note also. These are the essentially hybrid instrument, part debt and part equity. You take money now without giving up immediately that equity in the company. It will get converted into equity later, typically at the next valuation round, or upon highly like what are the predefined milestones which you have set in your shareholder agreement. And these are widely used in early stage funding where both sides want to keep things flexible, and especially popular among angel investors and VCs. Key features are that this will get preferential rights on dividend and repayment over equity shares, and there is no voting rights involved into it except on those special resolutions or ordinary resolution which will be affecting their rights. Here are the types of preference shares. There are like convertible preference shares. Convertible preference shares are those shares that can be easily converted into equity shares. Non-convertible preference shares. These are the instruments where we cannot convert into equity shares, which often treats as debt only. Redeemable preference shares. Preference shares are those shares that can be repurchased or redeemed by the issuing company at a fixed rate and predetermined date. These type of shares help the company by providing a cushion during the times of inflation. Non-redeemable preference shares. These cannot be redeemed or cannot be repurchased by the issuing company at the fixed date. The issuance of non-redeemable preference shares is currently prohibited under Companies Act, under Section 55 of Companies Act 2013. Participating preference shares. This will help shareholders demand a part in the company's surplus profits at the time of company liquidation. And however, these shareholders will receive the fixed dividend, but apart from the fixed dividend, they will also receive dividend when the company generates surplus in the manner. I can detail, but these instruments will be required detailed checklist, and this session is completely not like this session will not be completed if I started explaining all such instruments by pros and cons, like everything there. So coming to the non-participating preference shares, these shares do not have benefit the shareholders have. The additional option of earning dividend from the surplus profits, like these cannot be, they cannot derive the profit, they cannot derive the dividend from the profits, surplus profits. They have fixed dividend at the very earlier stage, which have been defined at the time of issuance, like what we have discussed for participating preference shares. Cumulative preference shares. Cumulative preference shares are that type of shares that gives shareholders a right to enjoy cumulative dividend payout by the company even if they are not making any profit. Like these dividend will be counted as arrears in years when the company is not earning profit, and will be paid on a cumulative basis in the next year when the business generate, when the company is generating any profits, they will be all accumulated, and in the later year when the profits are there, it will be paid out. Non-cumulative preference shares. Non-cumulative preference shares do not collect dividend in form of arrears. In case these type of shares, the dividend payout take place from the profits made by the company in the current year only. So if the company does not make any profit in the current year, then the shareholder will not receive any dividend for that year. Also, they cannot claim dividend in any future profit or year. Now, there are the compliance requirement. For redeemable preference shares, it must be redeemed within 20 years. With there are certain exceptions for the infrastructure projects, and pricing guidelines need to be adhered to. It can be done through private placement, and accordingly with the process for following of the issuance of offer letter and increasing of share capital, and redemption can be done through profits or by issuance of fresh shares. Now, the next instrument will be CCD. This instrument will be called as debt instrument, which will be mandatory convert into equity at later stage. This will carry an interest like a loan. This will not carry a dividend. It will be considered as a liability in the books of accounts until conversion. So, the conversion ratio and period should be upfront decided at the time of issuance only. This would be required a valuation from a registered valuer, and if the foreign investments are involved, then the FDI pricing guidelines and valuation norms need to be adhered to. And there is no specific tenure for conversion with agreed period. So it can be the period which investors can be agreed on, but usually it is less than 10 years, and you have to maintain the registers. Next is the convertible note. This is a type of debt to equity instrument. Key features are, these are the initial debt instrument where they have an option to convert into equity at a future event, example at a next funding round. It is popular with the early stage investors. There is no immediate dilution for shares for founders, and this will be allowed for DPITs, recognized startups. Convertible, and should be convertible within 5 years from the date of issue. Now coming to the debt instrument. This is what we say capital without dilution. And finally, if you are particular about maintaining control, you can raise funds via pure debt instruments. That means by taking loan from bank or NBFC, or through venture debt, or as a structured debt instrument like non-convertible debenture. Yes, debt allow you to avoid equity dilution, but the cost of debt in terms of interest and in terms of repayment obligation is usually higher than the long term cost. Okay, so it is higher because interest usually, it's a yearly based thing, and it will in comparison to the cost of equity or convertible instrument, it is bit higher side. So if you are startup in a revenue generating phase, or you expect to a quick payback from the capital, that might be a good option for you. Each tool has its own compliance requirement, tax implication, and investor expectation. So before issuing any instrument, it will be crucial you to understand the stage of your business, your funding requirement, your appetite for dilution, your cash flow, and repayment ability. So now let me walk you through the very practical and brief process of how fundraising actually help for startup. The first step is to decide valuation. At what valuation do I want to raise fund? This is not just a random number. It's actually based on your projections, market potential, current performance, and how much capital you actually need to hit the next milestone. Once you have arrived to the pre-money valuation, your post-money capital can be estimated. This helps you to define how much equity you are giving away in exchange of the investment. Okay, so second would be a legal agreements like defining your SHA, SSA, and term sheet. Once valuation is clear, the next stage is to draft your key investment agreements. Term sheet will be a non-binding. If it be signed, it will be binding. Summary of the deal terms, and the next would be SHA. It will cover rights, responsibilities, exit terms, and governance manner in the same. SSA would be a shareholder subscription agreement. It will define how many shares will be issued, at what price, and other transaction specifics. These documents protect both the founders and investors and help avoid any surprises later in the later picture. So, coming to the board meeting parts, like board and shareholders approval part, once terms are settled, you will need to call a board meeting, then call a general meeting of shareholders. Here you have to approve the issuance of securities, have to approve the offer letter, and accordingly pass necessary resolutions. This offer letter will be prepared and circulated to the potential investors. And now this is a critical part: receipt of fund. Make sure that the money is actually credited to the company designated account before you proceed to file any form. Don't be hurry to allot shares just because the investor said I am entrusting it, like I'm transferring it tomorrow. So wait until the bank statement reflects it. The transfer that reflection will become the evidence of your subscription. So the next step will be the compliance filings. This would be covered once you receive the funds. Then you have to conduct a board meeting to approve the allotment of shares, and accordingly you have to issue share certificates or debenture certificates if applicable. Like what are the instrument you are issuing at that stage, and then accordingly file pass three with the register of companies within a certain period of time which is laid down in the Companies Act. Important note for founders: do not utilize investor money before the pass through is filed. As per Companies Act, you are not allowed to use the funds until this return of allotment is submitted. This is the one of the most common compliance mistakes, and it can lead to penalties. Once thing is being done, once your pass through is will be filed, and private limited then the private company has to issue this has to get the stamp duty process will be done, and accordingly the stamp duty has to be paid on share certificate within 1 month from the date of issuance of share certificate. For what are the risk of non-compliances? In case of absence of valuation report, like you don't have valuation report properly on the manner on the methods which been defined under income tax act, like DCF method, discount and cash flow method, there are net asset method. So you have to get this valuation report. Firstly get valuation report from the register valuer. As per Companies Act, register valuer is the only person who can authorize to issue valuation report. As per FEMA Act, there are SEBI category 1 merchant banker or a chartered accountant as specified therein. So you have to, in case of FDI investment, and you have to follow both the routes. You have to get this thing done from RV also, register valuer also, and through category 1 merchant banker also, if it is FDI in case. Further, in case of misstatement or false statement in offer document, if you have misstated your figures in your offer document, in your offer letter, that's class 4. So in case if you have not provided the true figure of financials, true figure of what are the events have been made last year, so that will bring a huge penalty on the company. And the other one is the consequences of non-filing of pass 3, acceptance of money from the investor in the contravention of the provision of act, and non-reporting of or delayed reporting of remittance to the RBI. If you delayed in reporting of FCGPR form, like whenever we issue shares to the foreign investor, then we have to file FCGPR form with RBI. And if you miss that filing, then RBI will impose late submission fees as per its own discretion, which depends on the remittance amount. So, delayed in payment of stamp duty on securities, it can be the penalty will leads up to 10 times of the stamp duty amount. Imagine if you have just closed an investment, says about 1 lakh worth of shares or debentures. Now, technically, stamp duty on that transaction is very nominal, just a few hundreds depending upon the state. But here's a catch. Many startup forgot those or ignore paying this tiny stamp duty amount. And then what happens? You not only have to pay original duty later, but also with the penalty that could be several times the actual amount. And on top of that, you will be wasting time making multiple visits to the registrar office or stamp authorities just to get the documents regularized. So that's why I always tell founders compliance don't usually hurt your business when done on time, but neglecting them creates cost you have never budgeted for. Now coming to the ESOP structure. Generally, whenever we define cap table and at initial stage, we have to talk about ESOPs also, because even the investor is some kind of they have incorporated the term sheets that they want to incorporate the term sheet to issue ESOP from their own capital, so that later dilution doesn't happen. Similarly, so from the company perspective, to retain the right tenant, they have to roll out these ESOP schemes at the very first time. So you will often see a clause in the term sheet that says something like a 10% or 15% of ESOP pool to be created pre-investment. That means, let's say you are raising funds at a 10 crore valuation. The ESOP pool has to be carved out before the investor shares are allotted, so that their ownership will not be diluted later. They take care of at the very beginning. But here's a pitfall. Many startups announce ESOPs casually without conducting board approval, without having shareholder meeting, without valuation, and without filing the necessary forms for that. When investor asks you for due diligence later, these gaps show up instantly. So my advice here, there's a legal instrument. If you don't set up them right, they will become a legal headache and at the later stage. Also, employee stock option plan is a form of employee compensation where a company grants its employee the right but not an obligation to buy a certain number of shares at a predetermined price, that is an exercise price, what we called on, after a vesting period. So, what will be the benefits of ESOPs? For startups, like it will attract top talents without high salaries and retain employees with vesting structure, align team interests with founders investors, enhance their valuation in funding rounds, and for employees, it will offer you the ownership and wealth creation in the company, gain from the company wealth and company growth and the valuation, motivates your performance and long-term commitment, tax deferral benefits in startup definitely. And what are the key terms what we use in ESOPs? First one is the vesting period, the time employee must work before earning the right to exercise options. So they have this gap of time. So till then they have to think upon like how much what is the best option for them to exercise, and when is the best option to them to exercise. Exercise price period, price at which employee buy the shares. It is typically lower than the market value, and mostly it is predefined in a manner. Exercise period, time limit within which the employee must exercise after vesting or exit from the company. Grant letter, like document specifying the it is a document which specifies the number of options which will be granted to the employee. Exercise price, how the exercise price will be valued at the time of issuance, and the vesting terms. Now we talk about the rules to offer ESOPs. ESOPs are typically offered through two main routes. One is direct and the other is trust route. The direct route is a streamlined process for smaller programs. In direct route, a company can issue stock directly to eligible employees. After a vesting period, employees can exercise this option and receive company shares. This route is particularly suited for the companies with a smaller base or single ESOP plan. It has a straightforward structure and relatively low administrative requirements. So you only need to formulate a plan for the company, only have an ESOP plan therein, and there is no creation of any trust or any entity involved into it. The other is the trust route, that is the optimized for larger workforces. The trust route involves establishing an employee welfare trust that holds on behalf of employees either through fresh issue of shares or by acquiring shares from the secondary market. Company with large workforce often favor this approach because it simplifies the transfer of shares to employees, allow for internal trading marketplaces, and create a centralized platform for management of shares. Criteria. Like we coming to the criteria, who will become the shareholder of the company? For direct route, employees will become the shareholder of the company on the exercise of the option by them. And in indirect route, trust will become the shareholder of the company, which later on transfer shares to the employees at the time of exercising of the option by them. Dilution of shareholding. Dilution of shareholding of a company will be at the time of allotment only to the employees pursuant to the exercise of option by them. Like like you have created 10% ESOP pool. Now the vesting period is about 1 year, say so. And we have issued shares, we have issued these grant letters 1 year before to the employee, to the selected employees. Then after they have been exercising option after the completion of vesting period. Once they exercise this option, then we have to issue share certificates to them, and then accordingly we have to file tax reform for this. And on the every stage, your dilution will be affected. Your shareholding dilution will be affected. Your cap table will be changing whenever you issue the ESOP to the selected employees. In indirect route, there is no dilution of shareholder company at the time of allotment to the employee at the very future, because in indirect route at the very first point of time we have created this ESOP trust. Company already allotted certain amount of shares to to this ESOP trust, and those shares, once they have allotted to this ESOP trust, they will become the part of the register of member of the company. They will be the shareholder of the company. And once they become the shareholder company, and after process for grant and vesting and exercise is same for them. Like once the employee exercise this option, this ESOP trust will transfer their certain amount of share where they have exercised to that transferee, to that employee basically. And this will not cause an illusion, because trust has already have those share certificate issued in a real manner. So it's just a transfer things happening in there in the ESOP trust. For early startup, it will be cost effective, like ESOP will be cost effective and more convenient than forming a ESOP trust. And ESOP trust, it would be preferred route for large companies only, because it requires more complexities like drafting of your trust deed and getting it registered, all such things in the manner. So let's just understand the stages of ESOP implementation. First, I'll just cover the ESOP pool plan first. So first, you have to create an ESOP plan, right? Then after, you have to implement that ESOP policy in the company by way of approving board and shareholder, by way of taking board approval and shareholder approval. Then after, you have to issue this ESOP to employees, like by way of issuing grant letters. And when they have received the grant letter, then the employees will become the eligible to earn that right. And after that, in the grant letter, there is a vesting period involved into it. Usually it is minimum 1 year, and it can be more than 1 year also. So once the vesting period expired, then accordingly they can exercise the option and purchase the shares in the company. So this is the stages of ESOP implementation. Now, moving to pitching to investors. So when we go to the investors, I have prepared this PowerPoint to give you a holistic view of the startup mechanism. So when we talk about the investor, we also telling about that how to introduce your concept to the investors that serve the economy at large. Then we go to the market strategy, then how you will go to the market, and then after how to craft a compelling pitch deck based on these factors. Moving to the compliance with FDI norms, let's now shift our focus something that is absolutely critical when it's come to startup funding, and that is foreign direct investment compliance, or simply a foreign direct investment compliance only. So now why it is important? Because at the moment you are accepting money from foreign investor, you are not just dealing with the internal company laws anymore, like Companies Act. You are stepping into a framework which is governed by RBI, FEMA, and the FDI policy, which is issued by Government of India. And let me tell you, FDI compliance is not optional. Every step has to be done through diligence and precision. Sectoral restriction. No, this is not for the all industries are the same, because not all industries are the same. One of the first things you need to know that is FDI is not equally allowed in all sectors. Some sectors allow 100% FDI in the automatic route. This means there is no prior approval government route is required. Sectors like IT services, e-commerce markets, startups and tech domain fall into this category into a certain manner. But then there are certain sensitive or strategic sectors like defense, real estate, multi-brand retail trading, and tobacco, atomic energy trading. Like these sectors have FDI caps, and in some cases, government approval is mandatory required. So policy, we have to understand that policy keep on changing. Now here's when the things get tricky. The FDI policy is also dynamic. So today a sector might require approval. Tomorrow it may move to the automatic route, because this FDI policies will not be keeping same for the like for 1 or 2 years, because Government of India keep on bringing changes in the FDI norms. So to conclude this section, FDI is great way to raise capital, but it comes with high regulatory responsibility, and that's our role as a professional or consultant become extremely important. As a company grow and begins to look beyond Indian borders for capital, the foundation must be solid. So the FDI compliance is not just a paperwork; it's marks for the credibility, trust, and global readiness. Let's keep ourselves updated and stay compliant and help India startups so that we can go globally safely and legally. As professionals, we make it point to stay constantly updated on all stages and changes and developments in FDI policy regulation. The vigilance allows us to proactively inform our client about any new rules or amendments that may impact their investment. So by doing so, we ensure that remaining fully compliant and we can make timely decisions also, well informed decisions. Our role is not just to reach but to anticipate these changes, so we can guide and support our client effectively at every step of every such step on the way. Now moving to the annual compliance. Now let's focus on the critical annual compliances that startup company must fulfill. Especially important while preparing for fundraising, as investors and due diligence process scrutiny become scrutinized. They will scrutinize very closely in the manner. So for private limited company, certain annual ROC compliances are like first is MVP1. Like this is a disclosure of director interest at the first board meeting of the financial year. And the second one is DI rate. This is a disclosure of a disqualifications of the directors at the first board meeting of the financial year. The third one is MSME filing. MSME 1, it will be a return for delayed payment to MSME. It is filed twice a year by April 30 or by this October 30. Then after it comes like PAS 6. It's a reconciliation of share capital, which will be happening twice a year. Then after coming to FC4 and FC3, this is the annual return and annual accounts filing form for foreign company only. DPD3, this is a return of deposits form which will we have to file if a company have accepted any deposits, or if a company has taken any loan which will be exempt, which will becomes an exempted deposits. So for this like loan or advances from the other company. So even if this doesn't fall on deposit guidelines, then also you have to file TPT3 form. FLA return. This is an annual return on foreign liabilities and assets. So basically, whenever we receive any FDI, or whenever we see any, whenever we make any ODI, like any foreign investment or any foreign transaction is reflecting in your asset side or liability side of the company, of the balance sheet of the company, then you have to file this form, FL return form, for that matter. Then after we come to DIC KYC, which we have to do annual basis. Then there is the 81 form. This is the appointment of auditor form. This is an event based form. Like it will be required at the time of incorporation, it will be required in the first AGM. And whenever there is a change in the auditor's terms, then it will be required to file with the ROC. Then there is AOC for XBRL form. This is the filing of financial statements form. This is the annual based form, and along with MGD7 also. It's an annual return form. The other one is a CSR2. It's a corporate social responsibility reporting form if it is applicable. Like if your company exceeds certain amount of turnover, net worth, or profits in a previous year, then you have to file CSR2 form. Then there are other guidelines also. There are other things also which you have to follow for a corporate social responsibility compliances. MSME fund form we have already discussed. Like coming to MGD 14, it is a filing of board and shareholder resolutions, annual performance report. For like in case we have made any ODI, like if we have make any investment outside India, then you have to file annual performance report by 31st December every year, reporting to RBI, like reporting the financial statements of the foreign company, foreign subsidiary or wholly subsidiary company, by reporting this financial statements, also by reporting the what are the dividends have been received during the year, if the disinvestment has been made during the year, any sort of thing. Timely compliance with these filings is critical to avoid penalties and maintain good corporate governance standards. So then after we come to board meeting. So as per section 173, we have to conduct at least 4 board meetings annually, ensuring that not more than 120 days gaps lapse between 2 board meetings. For smaller companies, it is minimum of 2 board meetings required per year. At least 90 days gap should be there between them to be between them is allowed. And then we come to AGM. AGM must be held within 6 months from the date of the end of financial year, typically by 30th September. For LLPs, now coming to the compliance for LLP, now there are only 2 forms which were required. That is Form 11, that is annual return, which must be filed by 30th May each year. Form 8, that is statement of accounts and solvency, must be filed by 30th October. And there are additionally event-based forms such as Form 3, LLP agreement information, and Form 4, like change in partners information, that is required when it's applicable. Form 3, when you're making any amendment to the LLP agreement for that per se. And audit requirement is mandatory if LLP exceeds certain limit like 40 lakh in any financial year. If they exceed the turnover with the 40 lakh, or if their capital contribution crosses 25 lakh at any point during the year, then they have to make this audit requirement completed. While the compliance I have outlined as a part of annual mandatory requirements, it is equally important to understand that many other compliances are event based. They are not tied to the calendar year, but are triggered by the specific actions or changes within the company, such as allotment of new shares, changes in the director or key management person, transfer of shares, transmission of shares, issuance of debentures, CCDs, change in the register office within the state to state, or entering into any late file transactions with the company, with the late parties of the companies. So any loan and investment transaction covering external commercial borrowing, like if you obtain a loan from Indian company, it will section 186 of Companies Act 2013 will be applicable. With the professional help, you can go with the compliance for that matter. And if you're obtaining any borrowing from outside India, then you have to follow the ECB framework, that is external commercial borrowing framework, There is a certain limit for the startups also. It is allowed for startups to a certain limit, and that also can be done through professional help. Each of them triggers specific forms, timelines, and approval, and missing any of them will lead to penalty, or worse than that, delaying in your funding process. And then after, where the role of qualified professional become this at this stage, our role become very critical. As a consultant, we not only help with the routine filing, but you also will also ensure that moving legally and compliantly while safeguarding both the company also and the founder personal interest as well. Okay. In summary, these statutory compliances are not negotiable and form the backbone of the company, legal standing, and build the investor confidence also. Ensuring timely and annual filing build trust and transparency, making the fundraise smoother and less risky for all the stakeholders. Now let's talk about the something that doesn't always make it in the limelight, but can make or break the startup, and that is record keeping. Let's look at the four important pillars. Documenting every major event. Startups are fast moving, but every decision must leave a trace. You must have a document and keep signed documents for every board meeting and every shareholder meeting. This is not an optional, it is a non negotiable legal requirement under Companies Act. Now doing this, if we don't maintain the proper minutes in the manner which is required under Companies Act, it will invalidate your decisions and will create confusion between the authorities and the approvals made during the period. So the second one is maintaining a clear cap table. Your capitalization table is what shows who owns how much of the company. This is one of the first things an investor or auditor will ask for. So it must be 100% accurate and updated immediately after any issuance or transfer or conversion of shares or options. And any mismatch between actual ownership and when it records, it can delay the deal instantly. The third one is organized records. All your employee contracts, your non disclosure agreement, your vendor agreement, your customer deals, your statutory registers, everything must be stored systematically and securely with the compliance officer or with the person who is authorized for that. Your books must be closed and reviewed regular, not just at the end of the year. Investors will look for the hygiene in the accounts and consistency in reporting and organized operations. So this is the most important part. You have to maintain your statutory register in a form like all such transaction. Whenever there is a issuance of instruments, that transaction must be recorded during in the due timeline. And in case of like if there is any change in directorship, if there is any cessation of member, it should be recorded with the due timeline. If it is missed and if it's catched by any authority or during the due diligence, it will be a deal breaker for the company. Now the fourth one is data protection measures. And finally, in today's world, data security is compliance. Store your documents in secure cloud folders with the offline backups. Monitors who can has this access to it. Not everyone should have access to it. Your compliance officer should be in the picture, or the directors, or the person who's authorized by the board for that matter. And as professionals, we are here to help you navigate all of the work end to end. Whether it's drafting minutes, maintaining an updated cap table, setting up of secure document repository, or ensuring data protection protocols, everything will be in place. This would be with this will be act as a we can act as a strategic compliance partners for that. Our job is not to help you meet the legal compliances only, but to make you startup investor also ready, like audit ready and future ready at every stage of time. Coming to common pitfalls, now let's we talk about the common pitfalls like what all the startup will face and which we can avoid, like delayed or missed ROC filings. This can lead to heavy late fees and heavy penalty for that, and company status can be marked as non-compliant. Disqualification of directors can also be happened. Once you've been become the disqualified, then you cannot be qualified to be director in the other company. So you have to keep in record that your all your AOC 4 form, MGD 7 form, annual filing forms, all the SS 7 forms or DI 12 forms have been filed properly in the time manner which is laid down on the Companies Act. Second is the importance of maintaining of statutory registers. Register like MBP1, like disclosure of interest, MBP4, further disclosure of interest, SH6, register of director, register of member, and so on. There are many more for that. Most after forget these because they are visible, they are not that visible until the investor bring in during the due diligence process. Not maintaining them can lead to a legal scrutiny, or it will be a failure for that at the time of investor checks. Third is to failure to conduct a board meeting and shareholder meeting. You need minimum 4 board meetings per quarter AGM. Signed minutes must be maintained. Small team must often skip this process, but that's a big red flag during fundraising because usually if you don't do everything on time, like all your board meetings is not recorded in the minutes in time, you might miss some resolutions which has been discussed or which has been raised during the meeting and has not been recorded after the meeting, and that can lead a misleading document for you. Now coming to the non-compliance with ESOP regulations, no proper board resolution is sure to pass, and if the ESOPs have been given to the ineligible person like promoters are not eligible for ESOPs, so you cannot issue ESOPs to the promoters. And promoters, you have to check the definition of Companies Act. It does not only include the shareholders part, it will include the person who has significant control in the company, so that has to be checked thoroughly for that. Any filing which has been missed during the process. Now coming to the non-reporting of foreign direct investment, we have already discussed that you have to file FCGPR for that, and you have to file FL return for that. You have to file annual performance report. So, and any changes which you made, like if you made an overseas direct investment or any change during the year you have made, you have disinvest certain part of the investment what you have made last year, like in that foreign subsidiary company, you have to report this to RBI. If you receive any dividend, or if you have repatriation of any dividend, or you entering into any commission agreement, you have to report to RBI for that matter. And non-compliance of these may resulting in missing this could be lead to FEMA penalties and maybe ineligible for future FDI. Using wrong instrument for fundraising, like missing instruments like unsecured loans, non-convertible debentures. You cannot misuse these instruments. Like you have to check your needs first, and you have to check your regulatory compliance first. If you have just because of your needs you are following that instrument and you're not following the regulatory compliances, this could be a total mismatch for you. So non-updating your director disclosure, we have already discussed. Non-renewal of your DPIT certificate. Like if you have DPIT certificate, recognition is not totally forever. You must track your 10-year window or your 100 crore turnover limit. If you have already exceeded, then you have to then this recognition will get revoked. Else, then after you will not get the benefits as you are getting earlier. So else you lose tax exemption, you will be losing ESOP tax deferrals and investor interest in the company. And honestly, most of these pitfalls happens not because the founders don't care, but because they don't have the right compliance partner to it. So these are the main thing. And coming to the, like I can discuss some common pitfall example, like failure to the comply with POSH regulations. Like POSH compliances apply to all workplaces in India, both public and private company, with having 10 or more employees in the company. And this will be applicable on startup also. There is no exemption to it. So for the same, establishment of internal complaint committee is mandatory, which will include presiding officer, a senior woman employee of the organization, having at least two members in the company, two employee member. One of them should be a woman, and an external member who will be having an expertise in POSH compliances. For this purpose, you have to file annual report with the district officer. The deadline is 31st January for this. Let's discuss one scenario on this, that there is a startup with 15 employees which does not have posh policy into it. Internal complaint committee, they have not formed this internal complaint committee also. They have not conducted any training in place. So what are the risks for that? You will find up to 550,000 under Posh Act, and your reputation will be gone down, can be damaged like completely. So, and you will be facing potential lawsuits or employee attrition due to the unsafe workplace environment. Investment will become the red flag for the investors while due diligence process. So, what is the mitigation plan? So, it should be an immediate compliance. First, we have to draft and implement a POSH policy. Then we have to conduct. Then we have to call a board meeting to approve this POSH policy, and accordingly, we have to form internal complaint committee, including the external member. You cannot have an internal complaint committee without bringing the external member who has this knowledge in this POSH compliance, this POSH Act. So then after, you have to conduct awareness training sessions for all the employees. This should be recorded one, because these pictures, like all this training pictures, all these certificates, what you have been generating during the sessions, you have to submit to the district officer at the end of year, that is at the beginning of next year, that is 31st January. Now then you have to conduct a documentation on audit. You have to maintain records of complaints, resolution, and training sessions. Whenever you receive a complaint, whenever those complaints have been received, you have to call an internal complaint committee in a timeline which is led under POSH Act, and that internal complaint committee will do all such things, like they will first they can have a separate call with the
Mona, sorry to
complaint.
interrupt in between.
Yeah.
I
So yeah,
think we are running a little over time, so maybe we can
yeah, we can wrap it up,
start wrapping
definitely.
up the session.
Yeah, definitely. So
If you have
I
any
just
more slides, then we can just.
Yeah, definitely. I can just cover the exit strategies if it is required, or we just switch to the question answers round. And before question answer round, there are a few questions what startup used to face at the very first point of time. Like, can I succeed? Like, I just introduce those questions first. Then we can have a Q&A questions. That is fine, Shruti?
Yes, yes.
So, can a subsidiary private limited company whose holding company is a public limited company can be registered as a startup? So the answer to this is no. Why? Because the moment a private limited company becomes a subsidiary of public limited company, it is deemed to be public company under Companies Act 2013. And as per DPIT regulation, a public company cannot be recognized as a startup. So even if you're a subsidiary, even if you're a private limited company, being a subsidiary of a public limited company, your nature is private limited, but you cannot get this DPIT registration at the very first point of time. So you have to plan your structure if you're being a group companies. So does next question would be, does a startup need to be based on intellectual property or innovation? Yes, to avail the startup benefits, you have to work first towards the innovation, or towards development of product or processes, or improving existing services. Like, think of it like that. You don't have to invent a big thing on that, but you must show some difference. For example, if you're running food delivery app, you can qualify it if you are demonstrate this innovation in your delivery process, logistics, or customer experience. So as I said, startup can raise external commercial borrowing. They can raise up to 3 million per financial year. Tenure must be minimum 3 years. It has to be compliant with the SEMA regulations. So is there any other questions which we can discuss? Hello?
Yes, yes. So I think we have one question in the chat box from Bangalore B3 startup. What are the advantage of an OPC as compared to other forms of ownership?
Like being an OPC, you don't need to call board meeting on a regular basis. You don't need to conduct an AG. Like you only need to conduct an AGM, and that too, being a one member, you don't need to be physically present there. Only the signing of financial statements can serve for that. So you don't need to have a regular compliance which private limited company has to follow it. They have to they have to conduct a board meeting like every for 4 times a year, like maintaining a gap between them. But for OPC, there is no such requirement. For that, there are other regulatory compliance rules also, like which will reduce your workload for the OPC. So this is what it is. I can explain in detail, like if it wanted. Hello.
Shiva Kumar, there's one question from Shiva Kumar. Is there any leeway for the startup for submitting the annual returns?
Pardon, I didn't get you. Is there
Is there
any?
any leeway for the startup for submitting the annual returns? Shiva Kumar, you can just ask the questions. You can unmute your mic.
Yeah, yeah. What you have told is correct. Is there is any way that we can for the startup for submitting the annual returns and other thing?
Just to simplify the startup, like for companies that you are referring to.
Yeah, as a private limited company.
So as a private level company now, soon the government will be there is a talk about it, that government will definitely will be introducing, like Minister of Corporate definitely will be introducing streamlined process, like reducing the compliance process. As of now, it is same. Like you have to file AOC 4, you have to file MGD 7, you have to conduct board meetings for that manner. For board meetings, of course, for startup it is 2 in number. For normal private limited company, it is 4 in number mandatory. So for that, definitely there is exemption for board meetings conduction. But for filing purpose, there are same thing. And for that purpose, now Government of India is working on that to simplify more into it. And this definitely will come in near future, because that is in pipeline.
Thank you. Thank you.
So if you have any other questions to Mona, please write it to me. I will just share my email ID and also contact number. I will pass it to Mona and you can get the answer. Thank you so much, Mona, for the insightful presentation. I think you have
I'm sorry.
covered everything related to startup compliance, starting from DPIT to structure of startups to compliance, annual compliance. I think you have covered everything from A to Z. I am sure all the founders here also are walking away with a lot of practical takeaways on compliance. And thank you to everyone who joined us today and make it so interactive. So before we close, just a quick note. So if you need any further legal support or have any questions to Mona, do let us know and we will happy to connect you with the Saga legal team and Mona. And beyond that, if you are looking for some incubation support or acceleration or any guidance on your startup journey, you can reach out to us. I will just share my email ID in the chat box.
Thank
Thank you
you,
everyone for your
Shruti, for
time
your
today.
time. Yeah, thank you for your time also. I hope this session
Thank
has
you
helped
so
you
much.
understand what startups are required to function.
It was very helpful. It was very helpful.
Thank you so much.
Yeah,
Yeah.
thank you. Thank
So I
you.
have just dropped my email ID. You can reach out to me. Thank you everyone for joining today's session. Have a wonderful evening, everyone.
Thank you so much, Shruti. Yeah.
Bye bye.
Bye.
Recording stopped.